The next set of videos walks through the computation of diluted earnings per share for firms with complex capital structures. A complex capital structure exists when a business has convertible securities, options, warrants, or other rights that upon conversion or exercise could dilute earnings per share, and companies generally report both basic and diluted earnings per share on the face of the income statement. Recall our basic earnings per share takes net income minus any preferred dividends divided by our weighted average shares outstanding. Our diluted earnings per share adjusts for the impact of convertible debt as well as the impacts of options, warrants, or other potentially dilutive securities. Companies do not report diluted earnings per share if in their securities, if the securities are what we refer to as anti-dilutive. In other words, if we treated if they were converted, earnings per share would increase. So our diluted earnings per share calculation only includes dilutive securities. Let's begin by taking a look at convertible securities. We measure the dilutive effects from potential conversion of EPS, earnings per share, using what we refer to as the if converted method. This method for a convertible bond assumes that the conversion takes place at the beginning of the year or at the time the securities were issued, if issued during the year, and eliminates or restates our interest expense net of tax for any dilutive convertible bonds. For instance, if we had had $60,000 in interest on a convertible bond, we would not deduct that in calculating our adjusted net income, and in fact we would also have to reduce, or rather increase, the amount of income tax we paid because we don't have that deduction. So we will have an elimination of interest net of taxes. For instance, if a company reported $98,000 in unadjusted net income, that's $200,000 earnings before interest and taxes, minus the $60,000 in interest expense, minus $42,000 in taxes, and we had convertible debt. All of the interest expense was related to convertible bonds. Eliminating the interest expense would increase our taxable income as well as our taxes and our net income. The difference would be the $42,000 net of tax. So we would increase the numerator, and of course we'd also increase the number of shares outstanding related to the conversion of the debt to common shares. If overall earnings per share goes down, these are considered dilutive securities. If, however, earnings per share increased, this would be considered an anti-dilutive security, and we would not include it in our calculation of diluted earnings per share. Let's consider another example, preferred stock. If we convert the preferred stock into common stock, then we will increase the denominator, weighted average shares outstanding, but we will increase the numerator, because recall the numerator is net income available to common shareholders. And again, this is because for the purposes of computing earnings per share, we're going to assume the convertible preferred shares are converted to common stock. Now again, if this were to increase our earnings per share calculation, then the preferred shares would be considered anti-dilutive, and we would exclude them from the calculation. When we account for options and warrants, we use what's referred to as the treasury stock method. Recall, when an employee or other party exercises an option or a warrant, the company receives cash. Under the treasury stock method, we assume the exercise of the options or warrants occurred at the beginning of the year or later if the issue date was beyond the beginning of the year. And we also assume, and this is the important thing, that the company uses those proceeds to repurchase common stock for the treasury. So this reduces the number of shares outstanding. So in step one, the exercise of the option increases the number of shares outstanding, but this is slightly reduced because we assume the company uses the proceeds then to repurchase some of those shares for the treasury. Let's go ahead and take a look at our summary of our earnings per share calculations. For a simple capital structure, We begin by computing our net income applicable to common shareholders, or rather net income available to common shareholders, and that's simply net income minus preferred dividends. And again, preferred dividends are only subtracted if they are paid or are related to cumulative preferred stock. Then we compute the weighted average number of shares outstanding, and finally, we simply take income available to common stock and divide it by our weighted average number of shares outstanding to get our basic earnings per share. For firms with a complex capital structure, we need to do a dual presentation of earnings per share, our basic earnings per share, as well as our diluted earnings per share. And again, we only include potentially dilutive securities. And those, again, will include convertible bonds and convertible preferred shares. Again, we include them only if they're dilutive. Options and warrants if they're dilutive. And then other contingent issues will include if they're dilutive. And finally, we calculate our diluted earnings per share by adjusting our numerator for dilutive securities and the denominator, our weighted average shares outstanding.